What's up traders, welcome to Failure to Displace. In this video we're going to take a look at our favourite entry pattern, the unicorn model, this time on the 5-minute time frame as it occurred on EURUSD in the London session. I've closed this trade out in full at 3R after filling a 5-minute balanced price range. However, there's definitely potential for further upside, taking us into a premium of yesterday's range and a 1-hour balanced price range just above us here. Patience is not my virtue. 3 hours more than enough this morning after this back and forth consolidation. Let's jump into the high time frame analysis now. We'll see how the entry occurred on the 5-minute and also how if we were more patient and waited for the 1-minute entry we could have had an even better risk to reward. We'll start our analysis off on the 1-hour time frame just to try and get a bird's eye view of where we are in price action. You can see from this that we are still inside this very large 1-hour fair value gap. So we had the large move, news generated on Friday. We've begun retracing it, but we're still stuck inside Friday's range. So really not nice price action all this week. What is worth noting is that we have created some very clean and very suspect, in my opinion, relative equal lows at this point. So we've got sell side liquidity below us here. We put in a low just after the London session. On Wednesday, we came back, retested it into New York, pulled up, and then had another run at it through the Thursday New York PM session, failed to take it. So it generated quite a lot of liquidity at this lower end towards the bottom end of this fair value gap. I'm going to mark the lower end of the fair value gap, just to sell side as well, just so we've got a reference coming into the session. Obviously a large bearish move then moving down Thursday afternoon. And we're now consolidating inside this smaller range. Higher up we can see we do have a 1-hour balanced price range. So you have a bullish fair value gap followed by a bearish fair value gap. Where these two overlap is a balanced price range. So a higher time frame, 1-hour balanced price range, which would be a really nice draw on liquidity. We will take our fib from the high put in on Thursday to the current low, which would be here. See where our premium and discount is. So as we know, we would like to be buying in a discount. So we are buying low and selling in a premium, selling high. Therefore, if we're looking for sells, anything up towards this balanced price range above the 50% area of yesterday's range would be a great place to look for sells. And the next thing I'm going to note is just looking at market structure that we've put in on the 1 hour. So we put in a lower high, higher low, lower low, higher low. So we've swept this liquidity high, put in a low, we're bringing higher lows in here, so another higher low and a higher high. So you can see at this point, we've swept liquidity and we're putting in bullish market structure. And then coming into the New York AM session through New York PM, we're breaking lower. So we've got a break of structure at this point, potentially for a bearish move. We could come back and retest our optimal trade entry for a continuation lower. Again, retracing that large move that we had from Friday. So this is potentially a bearish reversal. Because we have our pattern now, where we have put in a low, put in a higher high, and then a lower low, we do have a breaker block on the 1 hour. So these consecutive down closed candles, they put in a swing low, they put in a new higher swing high, and then broke through. These did not hold as an order block. So if we were going to continue higher, we would have expected price action to have come back into this zone to then continue up, taking higher liquidity. Obviously, this order block, which should have been support for higher prices, failed. We traded straight through the order block with displacement, so very large bearish candle here, breaking through the bottom of the order block. We've then got a valid breaker block. We have a breaker block with a balanced price range and bearish fair value gap obviously inside it. So this is a legit unicorn on the 1 hour. So price could come back into this area, preferably into a premium of yesterday's range before selling off. But we do need to be aware that we do have a 1 hour breaker block area in this region. Let's drop to the 15-minute time frame and start narrowing this down. So below our 1 hour fair value gap, still in a discount, we do have a 15-minute balanced price range here. So this big displacement candle down left a very large 15-minute bearish fair value gap, which is this pink zone here. Inside there, we also have a bullish fair value gap. It did get tapped once. So this bullish fair value gap did hold price up once, taking us to the higher high there, but it wasn't closed through until this section here. So this is potentially a 15-minute balanced price range. Price may need to come back to this, and when it does come back to this, we could expect a reaction on the 15-minute time frame. See if I can zoom in and extend this across a little bit. So this is below the 50% retracement area, so this is still in a discount. However, there's potential for resistance at this level inside this larger 15-minute fair value gap. And then we will start off our session on the 5-minute. You'll notice that we have got the Asia high in here, so this extended green line is the Asia high liquidity that hasn't been tapped. So we are using our session liquidity tracker indicator for TradingView. Links to all of the indicators that I'm using on my charts are available in the description down below, along with a quick video that explains the various settings as well. So if you want to replicate my charts, you can head on down there for details. So we've currently got untapped Asia low, untapped Asia high, and as we mentioned, we've got these relative equal lows, this engineered liquidity that we've put in just above the fair value gap low, so the 1 hour fair value gap low, which is this lower black line. Drop on the 5-minute time frame. Just as a final bit of analysis, what I'm noting around this 15-minute fair value gap is a 5-minute balanced price range. So you can see we've got a bearish inefficiency here followed by a bullish inefficiency. So this would have been a 5-minute BPR. Price did come back into this BPR, but it wasn't respected. It's traded straight through. So this area still hasn't created the kind of reaction we would normally expect on a retest. This is obviously surrounding that 15-minute BPR that I highlighted earlier. So what I'm going to do is I'm removing the 15 and I'm going to go based on this 5-minute because it's slightly larger. It's over the 382 Fibonacci. Obviously still in the discount of yesterday's range, but a good area to be monitoring just in case we get a reversal. So we're in a discount of yesterday's range. We are really looking for long trades. So if we're looking for long trades, we're going to want to see a sweep of liquidity. Ideally, we want to see a sweep of these relative equal lows. If we get a pullback, I'm going to want to pull back into a premium. So I'm going to want to pull back into this balanced price range optimal trade entry area, then aiming to trade this down to the relative equal lows. Alternatively, we can look for a sweep of these equal lows and then for a reversal trade into a premium of yesterday's range. Start scrolling through price action now and see what we are presented with. Not going to take any action inside this range. We are literally waiting for a large move either out of the range or up into a premium. So as soon as London opens, we drive lower, we begin displacing lower. So we've taken the relative equal low liquidity now, that's all gone. Close through that, had a bit of a reaction there. We're going to drop to the 1-minute time frame. So we've not filled the fair value gap. This is the fair value gap low for a full fill. If we're going to fill that completely, that's that larger 1 hour fair value gap we highlighted at the start. But we have swept liquidity, so we could potentially get a reversal here. So we need to monitor what happens with this order block here. So for our reversal pattern, obviously we want to see a lower high put in, lower low, and then we want to break that to create a higher high. So we're sweeping this liquidity back into this area, into the breaker block, and then off we go to the races for a long position into a premium. So we're going to want to see displacement through this order block. We're closing through bearish fair value gaps. So we're seeing that bearish PD arrays at the moment are failing. The first thing we're going to be looking for is displacement. So this is potentially an inversion fair value gap. post-it note that I've put on my charts so that I don't forget on my computer screen, sorry, is where are the big candles? So let's look at this. We can see that this candle is a bearish candle, significantly larger than the candles around it. So although we've swept liquidity and we're pulling back into a range, we've closed over this they've closed over this bearish fair value gap and this bearish fair value gap. Not valid displacement for me because the candles aren't any bigger than the candles around them. I want to see significantly larger candles. So we've pulled in, we've had some hesitation around the order block. So again, it's not showing me strong displacement that a buy program is in place at the moment. Yes, we've created another inversion fair value gap at this point. And we do have a bullish fair value gap here as well. Let's just look at the candle sizes though, it's not clear displacement. So we trade through the top of the order block. Immediately pull back in. We've created relative equal highs here. So we've engineered some liquidity at this point. We've not broken structure. We didn't take this high. So yes, we closed through the order block. So potentially it could have been acting as a breaker block now. This is definitely not our unicorn model. There's too much hesitation getting through the breaker block. We don't have significant displacement through. We've not broken structure. We've just engineered liquidity higher. So I'm going to want to see a lot more confirmation before I'm looking for a trade long. We're at 220. So let's just monitor our 15-minute cycles. So let's have a look at 230. So again, larger bearish candle here. So we've got bearish displacement. We've disrespected bullish fair value gaps. We've disrespected this inversion fair value gap. You can actually see at this point, we are respecting 50% of this bearish fair value gap. So if we monitor the 50% areas of fair value gaps, we can kind of see if they're going to be strong and hold or if they are potentially a weak fair value gap. If 50% is holding, it's a good indication that this is a strong fair value gap. Have a quick wick into the fair value gap again. And then we are breaking lower. We've closed through that inversion fair value gap. Heading for the low. And eventually we sweep those lows again. So we can get rid of this analysis now. So that's why we wouldn't have taken a long at this position. No break of structure. Engineered liquidity at the high. No displacement through that order block. So we're pulling back into the range. So again, let's monitor our price action. We'll put in a high, put in a low, broke that low, put in a high, put in a low. We've not broken this, so this is still a lower high to a lower low. So for an actual confirmed break of structure, we need to be breaking this high still. So we've got relative equal highs here as a draw on liquidity. This is our break of structure. You may be looking at this. So we do have low to a low high there, but this is internal. It's not a valid break of structure for me. This is a low resistance liquidity run, if you like, which can take internal liquidity and then continue lower. What we want is a break of structure, so that's sweeping this high back into this zone to continue higher, which consequently means this price leg, these consecutive bullish candles, are our order block. I'm drawing them from the low to the high because that's more significant. Yes, we do have a bearish candle in the middle of there, but it's engulfed either side of it, so I'm not concerned about that one. I'm going to use this as the actual main order block. I want to see a closure through this with displacement to confirm that this is going to be a breaker block. It's rather large, so it's not really ideal what I want to see on the 1 minute. So already at this point, I'm thinking that I would need a higher time frame to confirm this as a breaker block. So coming through again, we're not displacing with larger candles. We can see that we've got a good move. We are closing through bearish PD arrays. It's not massive displacement. We've closed through, so this is the internal liquidity that I mentioned. So we've taken this internal liquidity and we are closing above it. Again, a strong move outside, so into that fair value gap. So we're seeing that bearish fair value gaps are failing. This is an inversion fair value gap. This is an inversion fair value gap. So that fair value gap that we were monitoring earlier is a strong fair value gap because 50% was being respected. It's just got closed through. It's now flipped to support. Price has tested it and then broken away. We've taken these highs now, so we do have a confirmed break of structure. And price goes higher. So at this point, I moved up to a higher time frame. We've got some choppy price action in here. It's not a clean move through the highs, but we do only have a couple of small bearish ones here. So I moved to a 5 minute just to see what things were looking like. And it does look much cleaner on the 5 minute. We can move to our 245 candle. There was no entry at 230, but we are now creating this pattern on the 5 minute. So we've got a high down to a lower high, lower low, lower high, and then down to a lower low again to a higher high. So we've swept that liquidity. So we're building our pattern. Come back into this order block, which is now a breaker block, and then away. So we've created our pattern, and inside this on the 5 minute, we have our fair value gap. So this is candle 1, candle 2, candle 3. We have a 5 minute fair value gap inside a 5 minute breaker block. So this is a unicorn entry on the 5 minute. So based on that, coming up towards 245, I was happy to take a long position from the top of this, top of the breaker block, stop loss just below the bottom of the breaker block. So this is where I did things a little bit differently because for me the stop loss was too high. At 9.5, essentially a 10 pip stop loss. If we were to cover the swing low, which I didn't like, having a stop loss that big, it means that the move higher is going to have to be quite a large move. I've seen many people as they trade the unicorn entry as a stop loss just below the breaker block. So that's what I went with at this instance, a stop loss just below the breaker block. We obviously have a bearish order block here, a bullish order block with these down close candles. We've got a fair value gap, bullish fair value gap there, and we have our breaker block as well. So that's the 3 PD arrays. Ideally you would put the stop loss below the low. I was being aggressive with my stop loss placement just below the breaker block. I'm going to take 50% of the trade off at 1-to-1 to make myself risk free. Again, this week the price action has been terrible, therefore I want to get risk free as quickly as possible because I've not got a lot of confidence in the way price is moving. I can see at this point we've engineered liquidity. We've got relative equal highs on the 5 minute. We've got some buy side here as a nice draw on liquidity. We obviously have the Asia high, so we're going to be taking profit before the Asia high. So if we come back onto the 1 minute, I took my entry on the 5 minute. However, I did note this candle here. So this bearish candle led to a high, which led to a new swing low. So although it didn't break this external structure, it did break internal structure at this point with displacement through it. So we had a fair value gap through that area. Whether you call this a breaker block or a failed order block, I'm not so sure. Mitigation block. There's this block here. What's significant about this is that if we pull a fib from the high to the low, falls into a discount of this price range. So it means that we would get a pullback into a discount for a good risk reward ratio. And when this tags, so I get tagged in top of there, so I'm tagged in at 251. I'm going to monitor this to 3 AM. You know that from if you've watched previous videos of mine, I like to synchronize my entries with the open of a 15-minute candle. So in this instance, I didn't. Slightly outside my usual playbook because I don't normally take trades on the 5 minute. and I was tagged in before the open of a 15-minute candle. If we are monitoring this area, so 50% retracement of the break of structure into this breaker block support area, so this potentially was resistance, now it's been traded through, it can act as support. Watch when this is tagged. It'll come in 56, 57, it's tagged perfectly. So I really like to be entered 3 minutes either side of the open of a 15-minute candle. This tags at 57, so exactly at that time. So if I'd have been patient, stuck more to my trading plan at looking at the 1 minute time frame for reactions, a reaction at 57 off a breaker block, off a fair value gap, after a break of structure, I think that would have been a legitimate entry. So there's a potential long position off there. Stop loss, I would need 3 PD arrays to act as a stop loss. So I've got the breaker block, I've got a fair value gap as well to place my stop loss on, and then I have this inversion fair value gap here. So I could place a stop loss just below here. So as opposed to having a 7 pip stop loss on the 5 minute or a 7.6 pip, I could actually reduce my stop loss to 2.8, so let's just say 3 pips. Much like the normal size stop loss that I would go for. If I didn't take the entry as it was tapped, this next candle, not that one, this candle would have been a surefire entry. So it's a pin hammer at 259. So that shows that this 50% of this fair value gap, the breaker block, is holding. So we could take an entry at the break of this high, coming into the new hourly candle opening. Again, close 50% of the trade off at 1-to-1 to be aggressive, which we instantly hit that. And then a much better risk to reward now. We're going to go take the highs. This is the power of entering at the open of 15-minute candles. You get in before the open of a 15-minute candle, there's a potential that you have to sit through a few minutes of consolidation, a few minutes of drawdown before the actual move starts, and this is the perfect example. If we were patient, waiting for the open of the 15, we could have used this support area along with this pin hammer candle to confirm an entry at the open of the silver bullet hour, so the open of a new hourly candle, straight away 0 drawdown. And we're away, risk free. We'll take those equal highs. We are risk free now on the 5-minute trade as well. So we had to endure a little bit of drawdown on the 5-minute trade, and then eventually we come straight up to get risk free on that trade. And then where's our target? We already highlighted it. The 5-minute balanced price range. I was going for the actual close I went for, just remembering the trade. 3R trade is where I closed out at. And so we expect these balanced price ranges to be balanced fully, which means I would expect a tap of the top of it to at least rebalance it. Price motors up really nicely. We do get some drawdown, so this is one important thing to note. There's our 1 minute. This is our 5-minute. So we've closed 50% of the trade off. So the position is only half the size. The 50% profit that we took at 1-to-1 cancels out any potential loss because we can only lose half of the trade. So the 50% profit cancels any potential 50% loss. So we are risk free on this particular trade. We don't adjust the stop loss. So this is really important, and this is a great example of why we don't adjust the stop loss. Price can do its thing. It's already well into profit. If you'd have adjusted your stop loss at this point to break even, just drag us on a little bit, you can see we do come back to entry. This happens time and time again. If you'd have pulled your stop loss to break even, well, you're going to miss out on any potential extra profits. Now we're still in a discount, the trade is still valid, and yet we've hit stop loss because we've gone break even too soon. We wait for this to run through. After we've hit entry, another interesting thing to watch. Again, I always talk about the open of 15-minute candles. We come back, we retest the entry at 4:30. So the open of a new half-hour candle, and then we get the volume for another drive up. So again, it's just showing the power of 15-minute cycles and why I like to monitor them so closely. Eventually get an injection of volume. Come up to rebalance the 5-minute balance price range. There's we take our profit at, would you know it, 611. Closing us out just over 3R on the 5-minute entry, which is the entry that I did take, and 7.7R if we'd have been more patient, waiting for confirmation at the open of a 15-minute candle using that support area and the pin hammer for the entry. So I hope that was insightful for you. It's definitely insightful for me. I've learned a few things coming back and reviewing this. Although the 5-minute was a great trade, the 1-minute would have been better if I'd have just stuck to my guns and traded the 1-minute. If you found the video useful, then please do leave it a thumbs up. And if you've got any questions or feedback, then leave it down in the comment section below. It'd be great to hear from you. And if you're enjoying the content, then please consider subscribing. It'd be fantastic to have you on board, dropping videos like this more or less every single day. Thanks for watching, and I'll see you again in the next video.